So with the big pictures behind us, let's zoom in to look at some key macro indicators for the first quarter of 2026. In the first quarter, GDP expanded by around 7.8% year-on-year. This is actually the strongest first quarter growth on record. And this is particularly notable given the external volatilities during the quarter, including the Middle East shock. What matters most is how Q1 typically relates to the full year growth. As you can see on the chart, historically, Vietnam's GDP tends to accelerate throughout the year, with Q1 usually the softest quarter due to seasonality, particularly around the Lunar New Year. In most years, full year growth ends up around 1 to 1.5 percentage points higher than the Q1 level. And if we apply that pattern to the current data, a 7.8% Q1 print would be consistent with the full year growth in the 9% range or potentially higher, especially if the external shocks are going to go away. So rather than just a strong start, Q1 is acting as a leading indicator for the year trajectory. Taken together, this suggests Vietnam is firmly on track for a higher growth path in 2026, supported by both underlying momentum and favorable seasonal dynamics. Building on the strong Q1 headline, what is equally important is the quality of that growth. It is clearly broad-based across sector and demand drivers. On the supply side, we are seeing industrial production and construction leading, supported by recovering in manufacturing and accelerating public investment. Meanwhile, services remain resilient, with stable domestic demand and continued normalization in activities, while agriculture provides a steady base, helping anchor overall stability. On the demand side, the picture is similarly balanced. Investment growth has moved into double digits, reflecting expansion in both the public, private, and also the FDI sectors. Retail sales are holding at around 9% year-on-year if we exclude the effect of higher petroleum prices, indicating stable and accelerating consumptions, while exports have continued to trend up strongly, particularly in electronics and manufacturing. And we believe this combination matters because it shows growth is not driven by a single factor, but by multiple reinforcing engines. And linking this back to the previous slide, the implication is clear. The stronger Q1 print is not a one-off. It is underpinned by broad-based momentum, increasing the likelihood that growth can be sustained through the rest of the year. Moving to inflation. So inflation has risen in the first quarter of this year. This is actually as expected, primarily driven by higher oil prices following the Middle East conflict. And transportation costs have been the primary contributor. In fact, if we look at the month-on-month increase in headline inflation in March 2026, the entire inflation can be explained by the surges in transportation costs. Importantly, we think this reflects a cost-push dynamic rather than demand-driven overheating. Domestic demand remains healthy, but not excessive, and food prices have stayed contained, supported by Vietnam's strong agricultural base. We expect inflation potentially trending towards the upper end of the government's target range of 4.5 to 5% if the conflict continues to stay for a prolonged period of time, as we mentioned on the first slide, 9 to 12 months. However, we also see several mitigating factors remain in place, including the diversified energy sources, domestic production capacity, and the policy tools such as the fuel tax adjustment and also the other monetary and fiscal policy that the government can deploy in the later part of this year. And so from a forward-looking perspective, inflation is indeed moving higher because of the Middle East conflict, but it remains very much manageable. And more importantly, it does not alter the broader growth trajectory in our views. Moving on to monetary policy, the stance remains broadly supportive, but with early signs of normalization. We believe we mentioned this in the previous webinar already, but looking at interest rate, both deposit and lending rates have remained relatively stable after having normalized in Q4 2025. This would reflect strong credit demand and improving economic activity. At the same time, credit growth in Q1 is running at around 2.2%, slightly below last year, 2.5%. Indicating that liquidity is still available, but being deployed more selectively. On the currency exchange side, the Vietnam dong has been relatively stable. If you look at the chart, it's actually one of the most stable currency in the region, down only about 0.2% year to date. And this compares very much favorably to currency like Indonesian rupiah or Thai baht, down about 2 to 4%. And this would highlight the relatively strong macro fundamentals in Vietnam. So in our view, the policy mix on the monetary side has been quite balanced. We have seen normalization from a loose and easing monetary stance, but it is definitely not yet tightening and is very much still supportive for GDP growth. And the implication here is that we believe rates will likely remain within a control range, consistent with sustaining growth rather than restraining it. Now, fiscal policy is clearly one of the strongest supporting pillars at this point, and this compares very much favorably to the past episodes of crisis. So government revenue in Q1 reached around 33 billion US dollar, significantly exceeding expenditure of roughly 21 billion US dollar, implying a sizable fiscal surplus on top of the $10 billion surplus for 2025. And this strong revenue base is important as it enables a continued acceleration in public investment. And we can see it clearly on the right-hand side chart in the data, with public investment disbursement increased from 4.7 billion US dollar in Q1 2025 to more than 5 billion US dollar in Q1 2026, extending a multi-year uptrend. And we believe this matters because public investment is not just cyclical support, it is also structural, particularly in infrastructure development. In effect, fiscal spending is supporting the near-term growth and also is laying the foundation for long-term productivity gains, while also helping to cap inflation. On the later part of what I just mentioned, we mentioned it in the previous webinar as well, because a lot of the investment is going to go into infrastructure that would allow inflation to be well controlled with the lower logistic costs. And so this combination is particularly powerful in the current environment, where both resilient and capacity expansions are equally important. Turning from policy to the business side, looking at business condition, the data continue to point to resilient expansion despite a more uncertain global backdrop. The Purchasing Manager Index, or PMI, has now remained in expansion territory for 9 consecutive months, mostly in the 52 to 54 range, indicating consistent manufacturing momentum. At the same time, FDI trends are strengthening. Registered FDI reached around 11 billion US dollar in Q1, while disbursed FDI came in at approximately 5 billion US dollar, reflecting both solid pipeline and continued executions. What we believe is important here is the combination. The PMI confirms near-term production momentum, particularly in export-oriented sector, while the FDI confirms medium-term confidence, with capital continuing to be committed into Vietnam's manufacturing base. This suggests that the current recovery is not purely cyclical, but it is reinforced by the structural capital inflows. Despite the global volatilities, Vietnam's production base remains firmly in expansion mode, supported by both domestic activities and external investment. And importantly, this increases the probability that industrial growth will continue to lead the economy into the rest of 2026, rather than fading after a short rebound. Now, on the topics of external strength, just to continue from FDI, exports also accelerated strongly in Q1, despite a still uncertain global backdrop. In Q1, export reached around 123 billion US dollar, up approximately 20% year on year. This is a very strong continuation from the last year. Importantly, this reflects both a recovery in external demand and Vietnam's structural positioning within the global supply chains. At the sector level, electronics and machinery continue to lead, benefiting from the early upturn in the global tech cycle and sustained FDI inflows into manufacturing, a very positive signal given the sensitivity to global demand. And at the same time, we see an increase in imports as well, and particularly this would reflect the demand in intermediate and capital goods, suggesting that firms are building production capacity rather than scaling back. And so despite the ongoing global uncertainties, Vietnam's export sector continues to expand at a solid pace, supported by its role in global supply chains and continued investment from multinational firms. Overall, external is continuing its path as a key growth driver for 2026. And to wrap up my sessions, these are our current projections for the economy in 2026. We remain cautiously optimistic and thus continue to project a slightly lower GDP than the 10% target set by the government, which, by the way, is still the target, remains to be the target that the government is looking to achieve for 2026 based on the conclusion of the National Party Congress recently. And even with a 9 to 9.5% GDP growth that we are projecting at the moment, we see plenty of upside in our forecast, especially if the government execution is carried out successfully and swiftly, and the Middle East situation is resolved relatively quickly.